Hello, today I have taken a topic how and why to set up a business in India. Now, India is a huge market. It has a population of approximately 1.5 billion and the median age is 28 years. If you look at the economy and its size, it is fifth largest, soon to go to fourth place, and it has GDP of approximately 4 trillion. Last year, it has received foreign direct investment of 70 billion plus. If you look at the digital infrastructure, around 900 million people have access to the digital infrastructure and they are on the internet. Government of India has introduced the Production Linked Incentive Scheme, PLI scheme, for manufacturing sectors. Now if you look at these things, that is a good enough compelling reason for any business outside India to come over, invest here, manufacture here and sell to the world market. It's a cost-effective, business can be easily scalable, and it's a strategically located and a strategically important country. You see the democratic setup, free and fair elections, independent judiciary, rule of law. All these are the reasons for any business anywhere outside India to come over to India and invest here. Now, any business, if it decides to come over, how to enter Indian market? In today's topic, we are going to deliberate on the legal routes through which a foreign business can come and set up its own manufacturing base in India. Now, there can be 5 different ways of legal entities which you can form here. Those legal entities can be: 1, wholly owned subsidiary, which is most popular. You can come here, you can own this entity 100%. Then there can be a joint venture setup where you want to have a partnership with the Indian business and set up manufacturing base in India. Third route can be you can set up your branch office of your foreign entity, your entity in India. And another route can be liaison office if your motive is just doing market research and not generating any income. Then the liaison office is the preferred route. And finally, the route of project office, where you want to execute a certain project. For that, you set up a business entity. So these 5 types of business entities you can set up. Now the question arises about the foreign direct investment, opening of the market, and what is the sectoral gap. If you look at the India's FDI policy, it is under the automatic route. Most of the businesses are under the automatic route. When I say automatic route, you don't need any prior governmental approval, and most sectors qualify under the automatic route, like IT, like manufacturing, like hospitality, e-commerce, infrastructure. These are the automatic route option. Then there can be a governmental route where you need prior governmental approval, like defense, like broadcasting, like print media or banking. And then there can be certain restricted areas where foreign direct investors are not allowed, like gambling, chit fund, tobacco, manufacturing, etc. Now, let us say if you decide to incorporate a wholly owned subsidiary, what you need to do? You need to have a digital signature certificate, DSC, for all the directors here. Once you have DSC, then the next step is obtain director identification number, that is called DIN, reserve your name, file a specific form for registration, that is called the SPICE Plus, then obtain the identity documents like PAN, TAN, certificate of incorporation. Once you have done with these things, you open your bank account in the name of the entity, newly incorporated entity. And finally, do file a form FCGPR with the Reserve Bank of India, which is the banking market regulator in India. So once you are done with the initial incorporation of entity, what to do next in the regulatory space? You have to do certain annual filing, hold quarterly board meeting, then get your accounts audited, then comply with the foreign exchange regulations, annually file FLA return by 15th July. Then you have to comply with the tax regulations. There is GST, the income tax, then you have to deduct tax for making payment, and most importantly you have to do the transfer pricing documentation, and finally the labor law compliances. Now, among all these things, the critical points are transfer pricing regulation. So all payments from your entity in India will be a payment to a related party should be on the arm's length and must be supported by a proper annual documentation. Then your bank account must be a single bank account, and that all the foreign transactions will be through that. You must have one director which is resident in India for 182 days, and then you can get your profit repatriated to your home country after complying with the taxation regulations. At least 2 directors are required for having a private limited company. So now a normal question may arise: what is the timeline, what is the cost? Now see, the timeline will be for incorporation, having a legal entity, 1 or 2 weeks. Then bank account opening will be around 2 to 4 weeks. Then tax registration 3rd and to 5th week, and state level registrations will be there. Now what is the indicative cost? So cost will vary. Governmental fees are fixed, that is not much, but you may need to pay for your consultant, professional chartered accountants will be looking after that. Fees will vary from 30,000 INR to around 100,000 INR. So, what is the key takeaways for today's discussions? One, India is a lucrative market, a huge population, huge consumption base, enabling environment, digital infrastructure, world-class digital infrastructure. That is a compelling reason for you to come and invest in India. The wholly owned subsidiary route is the most popular. Most of the sectors are open. So 100% FDI is allowed. And it is better if you engage a lawyer, come chartered accountant, who can support you. We are KPAM and Associates Chartered Accountancy firm based in Delhi. We do provide this support to foreign entities coming into India. Our details are as below. Thank you. We look forward to support you and have a long-term relationship with you.